Well, hello there. I'm Gemini.
Welcome. In this explainer, we are going to break down the essential numbers you need to understand for your 2025 Canadian federal taxes. We will walk through the key brackets, the most important credits, and the core calculations, step by step to give you a very clear picture of what to expect.
So here's our roadmap. We've organized this into 6 main parts. We'll kick things off with the tax brackets, which are the foundation of everything. Then we'll dive deep into all the major tax credits, from the basic personal amount to credits for dependents, work, and medical expenses. And we'll finish up by looking at mandatory contributions and those tricky benefit clawbacks. Let's begin. We're starting with the absolute cornerstone of the federal tax system, the marginal tax brackets. Understanding how this progressive structure works is, without a doubt, the most critical first step in determining your federal tax liability. Now, this table is absolutely key to understanding Canada's progressive tax system. A very common misunderstanding is to think that if your income is, say, $60,000, you pay 20.5% on all of it. But that's not how it works. You actually pay 15% on that first chunk of income, up to $57,375. It's only the income you earn above that amount that gets taxed at the higher 20.5% marginal rate. It's a fundamental distinction.
Okay, so once we have a basic tax calculation from the brackets, we can start to lower it using what are called non-refundable tax credits. These are incredibly powerful because they reduce your final tax bill dollar for dollar. So let's begin with the most fundamental credit, one that nearly every single Canadian taxpayer gets to claim.
And that is the basic personal amount, or BPA. Think of the BPA as the tax system's way of saying, look, a certain amount of your income should be tax-free, just to cover basic living expenses. Every individual is entitled to claim this credit, and it effectively creates a zero tax zone for the first several $1,000s you earn. But here's the catch. The BPA isn't a one-size-fits-all credit. It's actually income-tested. This reflects a clear policy choice to target more of the benefit to lower and middle-income individuals. So for 2025, if your net income is under about $178,000, you get the full BPA of $16,129. But for our highest earners, those with net income over about $253,000, that amount gets reduced to $14,538. So what about the people whose income falls right in between those two levels? Well, the system doesn't just cut you off. Instead, it gradually reduces the BPA using this formula. Now, it looks a little complicated, but the concept is simple. It ensures a smooth phase-out of the credit. The key takeaway is just that as your income climbs through that specific range, the value of your BPA steadily goes down.
Building on the concept of the BPA, the tax system also provides more relief for people who are financially responsible for their family members. So this next group of credits is designed specifically for those of you supporting a spouse, a child, or another dependent. Two of the most common credits in this category are the spousal credit and the eligible dependent credit. You might have heard this one called the equivalent to spouse amount. Functionally, they're very similar. They let you claim an amount equal to your own BPA on behalf of a dependent with low income. But here is the critical rule you have to remember. You cannot claim both in the same year. It's one or the other. You claim the spousal credit if you support your partner, or the eligible dependent credit if you're single and supporting a qualified relative. Now, beyond those basic credits, there's a whole suite of caregiver credits for those supporting individuals with infirmities. As you can see, the amounts and the rules can get quite specific based on the dependent's age and their relationship to you. For example, there's one amount for an infirm child under 18, but a different, larger amount for an adult dependent, and that one also gets reduced based on the dependent's own income. Okay, let's shift gears and look at a set of credits that are tied to very common life events and work situations. This group really covers the whole gamut, from costs associated with employment to the financial realities of aging and pursuing higher education. Here we have 3 very common credits. The age credit gives some tax relief to seniors, but it's important to note that it's income tested, and it gets completely eliminated for those with net income over about $105,000. Then there's the pension credit, which encourages retirement saving by giving you a credit on the first $2,000 of eligible pension income. And finally, the Canada Employment Credit is a small credit that pretty much every employee gets just to acknowledge the miscellaneous costs that come with having a job. For students, the tax system offers some really significant relief. The main one, of course, is the tuition tax credit, which basically turns a portion of your paid fees into a valuable non-refundable credit.
Now, a key update for 2025 is that while the federal government has eliminated interest on its student loans, you can still claim a credit for any interest you paid on amounts that built up before April 1st, 2023. And don't forget, the ability to transfer up to $5,000 in unused credits to a parent or grandparent is a really important planning tool for families. Next up, let's examine a group of credits that address significant and often very costly personal situations. These credits recognize the financial burdens that can come with high medical expenses, charitable giving, and living with a disability.
The charitable donations credit is really interesting because its value actually goes up the more you donate. So the first $200 of your annual donations gets you a credit at the lowest tax rate, 15%. But for any donations you make above that $200 mark, you get a much higher credit rate of either 29% or 33%, depending on your income level. It's a clever design that really incentivizes larger charitable gifts.
The medical expense tax credit is there to provide relief for significant out-of-pocket health costs. But the crucial piece to understand is the threshold. You don't get to claim your first dollar of medical expenses. You can only claim the amount that goes above a certain floor, either $2,834 or 3% of your net income, whichever is less. This really ensures the credit is targeted at those facing unusually high medical costs relative to their income. Here's a quick look at several other important credits. The Disability Tax Credit, or DTC, offers very significant tax relief to individuals with a qualifying impairment, and it's a gateway to other programs. We also have homeowner focus credits, like the First-Time Home Buyers Credit, which helps with that initial purchase, and the Home Accessibility Credit, which supports renovations to improve safety for seniors or individuals with disabilities. All right, for our final section, we are going to flip the script. Instead of looking at credits that reduce your tax, we're now turning to mandatory payments and repayments that can actually increase what you owe. We'll look at payroll contributions and then how certain government benefits can be clawed back if your income is too high. For anyone who's an employee, contributions to employment insurance and the Canada Pension Plan are mandatory deductions. For 2025, an employee will contribute a maximum of $1,077 to EI for the year and a maximum of $4,430 for CPP. These amounts are calculated based on your earnings up to a certain annual limit. Now, this is where things get very different for self-employed individuals. This is a critical point. You see, they're responsible for paying not only their share of CPP, but the employer's share as well. The result? Their maximum contribution for 2025 is exactly double that of an employee, coming in at $8,860. This is a massive financial planning consideration for any entrepreneur or contractor.
For retirees, this number is paramount. Old age security is a core retirement benefit, but it is income tested. As soon as a recipient's net income for 2025 crosses this threshold, $93,454, they have to start repaying a portion of their OAS benefits. This repayment, which we call a clawback, increases with income to the point where the entire benefit can be clawed back.
And a similar clawback provision exists for employment insurance benefits. If someone receives EI during the year but also has a high net income, specifically over $82,125 for 2025, they might be required to repay a portion of those EI benefits. This mechanism is there to ensure the program remains targeted at those who have suffered the most significant loss of income.
So we've covered the core components of the 2025 federal tax system, from the brackets that determine your rate, to the credits that lower your bill, and finally to the contributions and clawbacks that can add to it. This leaves us with one crucial practical question to reflect on. Now that you know these numbers, these thresholds, and these rules, how might you strategically approach your finances this year to optimize your own tax position?